Real interest rates and gold, the structural fracture of a decade-old relationship. For over a decade, the inverse relationship between real interest rates and gold prices served as one of the most reliable compass points in commodities analysis. The mechanism appeared straightforward. As real rates declined, gold's opportunity cost diminished, making the non-yielding asset more attractive relative to interest-bearing alternatives. This negative correlation, consistently hovering around 0.7 to 0.8 since the 2008 financial crisis, became embedded in algorithmic trading systems and institutional portfolio construction models. Yet since 2020, this foundational relationship has exhibited troubling signs of structural breakdown. Gold prices have demonstrated increasing resilience during periods of rising real rates, while traditional hedging strategies predicated on this correlation have generated disappointing results. The implications extend beyond mere academic curiosity. They suggest fundamental shifts in how markets price risk, inflation expectations, and monetary policy credibility. The clearest manifestation of this structural change emerged during 2022-2023. As the Federal Reserve embarked on its most aggressive tightening cycle since the early 1980s, real rates surged from deeply negative territory to positive levels not seen since before the financial crisis. Traditional models suggested gold should have experienced severe pressure, potentially declining to $1,400 by $500 per ounce. Instead, gold demonstrated remarkable resilience, maintaining levels well above $1,800 and periodically challenging $2,000. This divergence from historical patterns cannot be dismissed as temporary market inefficiency. The persistence and magnitude of the deviation suggest deeper structural changes in how markets interpret the real rate-gold relationship. Statistical analysis reveals the correlation coefficient between 10-year Treasury inflation-protected securities, TIPS yields, and gold prices weakened from 0.82 in the 2015-2019 period to 0.43 in 2020-2024. More concerning for traditional models, extended periods showed positive correlations, particularly during stress episodes when both real rates and gold prices moved higher simultaneously. The primary driver of this relationship breakdown stems from a fundamental shift in inflation regime dynamics. The post-2020 period marked the transition from a prolonged disinflationary environment to one characterized by persistent upward price pressures across multiple sectors simultaneously. This shift altered how markets interpret real rate movements and their implications for monetary policy effectiveness. During the pre-2020 disinflationary regime, rising real rates typically signaled successful monetary policy transmission and declining inflation expectations. Gold, as an inflation hedge, naturally weakened as these conditions reduced its hedging value. However, the current environment presents a different dynamic. Rising real rates may reflect central bank attempts to contain inflation that markets perceive as structurally persistent rather than cyclical. This perception creates a dual-edged interpretation of real rate movements. Higher real rates may simultaneously signal both tighter monetary policy and underlying inflation pressures that justify gold's hedging premium. The traditional assumption that higher real rates automatically reduce gold's attractiveness overlooks this new complexity in inflation expectation formation. Survey data from the Federal Reserve Bank of New York indicates long-term inflation. Expectations have become less sensitive to short-term rate movements, suggesting structural changes in how economic actors form expectations. This reduced sensitivity weakens the transmission mechanism through which real rate changes historically influenced gold demand. The unprecedented scale of quantitative easing programs implemented since 2020 has left permanent alterations to financial market structure that continue influencing asset relationships long after active intervention ceased. The Federal Reserve's balance sheet expansion of over $4 trillion created lasting changes in market liquidity dynamics, risk premia, and asset correlation patterns. Traditional real rate calculations based on nominal yields minus inflation expectations may no longer accurately capture the true opportunity cost of holding gold. The massive expansion of central bank balance sheets has compressed risk premia across asset classes, creating artificial floors under asset prices that persist even as policy rates normalize. Portfolio rebalancing effects from QE created structural demand for alternative stores of value, including gold, that appears less sensitive to traditional interest rate signals. Institutional investors, having experienced repeated cycles of aggressive monetary intervention, may now view gold as insurance against policy uncertainty rather than merely an inflation hedge sensitive to real rate movements. The portfolio balance channel, through which QE operated, pushing investors from government bonds into riskier assets, created spillover demand for gold that exhibits different interest rate sensitivity than traditional inflation-driven demand. This structural component of gold demand demonstrates reduced elasticity to real rate changes. The traditional risk taxonomy that classified gold as a risk-off asset has evolved significantly. Modern market dynamics frequently show gold behaving as both a risk-off hedge and a risk-on inflation play simultaneously, depending on the nature of underlying stress factors. Geopolitical tensions, particularly those involving major gold-holding nations, have elevated gold's role as a sovereignty hedge beyond its traditional monetary functions. Central bank gold purchases by emerging market economies, totaling over 1,000 tons annually in recent years, reflect strategic diversification away from dollar-denominated assets, rather than tactical responses to real rate movements. This shift in demand composition, from primarily Western investor-driven flows to Eastern central bank accumulation, has altered gold's interest rate sensitivity. Central bank purchasing decisions typically incorporate longer-term strategic considerations that exhibit lower correlation with short-term real rate fluctuations compared to tactical investor positioning. The increasing importance of geopolitical risk factors has created additional demand drivers that operate independently of traditional monetary variables. When gold rises during periods of rising real rates, it may reflect geopolitical risk premiums rather than failure of the traditional inverse relationship. Physical gold market dynamics have undergone substantial evolution since 2020, with implications for how paper gold markets, where most price discovery occurs, respond to real rate signals. Shanghai Gold Exchange premiums to London spot prices have exhibited greater volatility and persistence, suggesting fragmentation in global gold markets that may reduce arbitrage efficiency. The growth of physically backed gold ETFs, now holding over 3,500 tons collectively, has created a substantial pool of gold that exhibits different flow patterns than traditional investment demand. ETF redemption and creation mechanisms introduce lags and frictions that may dampen the immediate responsiveness of gold prices to real rate changes. Algorithmic trading systems that rely on historical correlations may be slow to adapt to structural changes, creating temporary inefficiencies that allow fundamental factors to override technical signals. The increasing role of passive investment flows through commodity indices further reduces the pool of active capital responding to real rate signals. The breakdown of the traditional gold-real rates relationship presents both challenges and opportunities for market participants. Traditional correlation-based hedging strategies require recalibration to account for the reduced reliability of this historical relationship. Portfolio construction models that relied on gold's negative correlation with real rates may need to incorporate additional variables, including geopolitical risk indicators, central bank policy uncertainty measures, and structural inflation persistence metrics. The simple heuristic of selling gold when real rates rise requires more nuanced application in the current environment. For central banks managing reserve portfolios, the changing dynamics suggest gold's role as a strategic asset may have strengthened even as its tactical correlation with conventional monetary variables has weakened. The increasing importance of non-dollar trade settlements and sanctions considerations may support gold demand independent of real rate movements. The structural changes identified suggest the gold-real rates relationship may continue evolving rather than reverting to historical patterns. Several factors support this assessment. Persistent inflation expectations above pre-2020 levels, continued geopolitical fragmentation of global trade, and finance and central bank balance sheets that remain historically elevated despite policy normalization. However, extreme moves in either direction, substantially negative real rates or significantly positive real rates, may still produce traditional relationship patterns. The structural breakdown appears most pronounced in moderate ranges, where multiple factors compete for influence over gold pricing. Market participants should prepare for an environment where gold's behavior reflects a more complex interaction of factors rather than the relatively simple inverse relationship with real rates that characterized the previous decade. This evolution demands more sophisticated analytical frameworks and recognition that past correlations may provide less reliable guidance for future price movements. The implications extend beyond gold to broader questions about how unconventional monetary policies have permanently altered asset relationships, and whether traditional economic models require fundamental recalibration for the post-QE era. Empirical analysis of daily price movements since 2020 reveals telling patterns in the breakdown. Rolling correlations between gold prices and 10-year TIPS yields show increased volatility, ranging from 0.9 to plus 0.3, compared to the stable 0.7 to 0.8 range in previous decades. This correlation instability represents a structural change requiring attention from systematic strategies. Option market dynamics provide additional insight into changing relationships. The implied correlation between gold and interest rate volatility has declined substantially, suggesting derivatives markets are pricing reduced predictability in traditional relationships. Gold volatility surfaces now exhibit greater sensitivity to geopolitical event risk. Cross-asset correlations reveal gold's increasing independence from broader financial market factors. The correlation between gold and the dollar index has weakened from consistent negative levels to frequently positive readings. Analysis of regional gold markets illuminates how structural changes manifest differently across jurisdictions. Asian physical markets show diminished sensitivity to Western real rate movements, reflecting regulatory factors and different local monetary conditions. Shanghai Gold Exchange data reveals persistent premiums and discounts to London spot prices, indicating structural market segmentation that weakens global transmission of Western monetary policy signals. The infrastructure supporting gold markets has evolved substantially through digital platforms and blockchain-based solutions, expanding the investor base beyond traditional participants. These technological developments may have altered response patterns to macro signals, with newer investor cohorts exhibiting different behavioral sensitivities versus traditional market institutions. The proliferation of mobile trading platforms has fundamentally changed gold demand composition now, introducing participants with different analytical frameworks compared to institutional investors. This demographic shift may partially explain the reduced correlation between gold prices and traditional macro variables, as newer participants may rely more heavily on sentiment indicators rather than traditional economic data when making investment decisions.